Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on Thursday, October 12th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. Tonight, we delve into a smorgasbord of developments that test the very fabric of trust in the crypto space. Trust is a big theme for the night, from BarnBridge's dance with the SEC to Elizabeth Warren's call for a swift crypto taxation. We'll also uncover the dramatic Depeg of USDR and the dwindling trade volumes at Coinbase. Lastly, we'll explore the groundbreaking moves in traditional finance with BlackRock and a cautionary tale from Lido Finance. Buckle up, it's gonna be a roller coaster. BarnBridge is a decentralized autonomous organization. They are under the microscope of the U.S. Securities Exchange Commission. So here's what's up. BarnBridge DAO recently opened a voting process to decide how to respond to an SEC probe. The co-founders, Tyler Ward and Troy Murray, were given the authority to undertake all actions necessary to comply with the SEC's demands. This move comes after their attorney, Douglas Park, informed DAO members that the SEC was investigating them. Park advised halting all work on BarnBridge-related products and ceasing compensation for DAO work until further notice. The DAO members voted unanimously to comply with the SEC's potential demands and even pay fines if necessary. Ward and Murray were nominated as special delegates to deal with the SEC, and Park will remain the DAO's legal counsel. The DAO's treasury was also given the green light to sell all the tokens it's permitted to sell. Now, what's the SEC's beef with BarnBridge? Couldn't tell you, because no specific order has been disclosed due to its non-public nature. But the SEC's investigation began in June 2023, and BarnBridge immediately paused all its work and closed its liquidity pools. The price of BarnBridge's native token, BOND, has been in a downward spiral. It had a local peak of $21.69 in July, and now stands at a paltry $1.67. That's a far cry from its all-time high of $185.70 in October 2020. And this is not the SEC's first rodeo with the DAOs either. Last year, they went after the American CryptoFed DAO for lacking vital information in their Form S-1 registration statement. So the SEC is clearly tightening its grip on DAOs, and BarnBridge is their latest target. BarnBridge decided to play it safe by complying with the SEC's demands, but this raises questions about the future of DAOs and their ability to operate freely. Are we witnessing the beginning of the end for DAOs, or is this just a bump in the road? Only time will tell, but one thing's for sure. The SEC is watching, and they're not messing around. Alright, you've just heard how BarnBridge is navigating the SEC's tightening grip on DAOs. Now let's pivot to another regulatory storm. This one's about your wallet. Senators are pushing for faster crypto tax rules. How fast? We'll find out. And this one's our cover story for tonight. Most times when I call something the cover story, it's not necessarily the most important story. I generate an image for every story for our YouTube viewers. So when something's the cover story, it's usually just because I like that picture the best. In this case, I would say that this is the most important story of the lot. Hold on to your wallets. Senators like Elizabeth Warren are pushing the IRS and the Department of Treasury to fast-track crypto tax rules. They're not content with the current timeline that would see those rules implemented by 2026. Instead, they're pressing for immediate action. Why the rush? Well, they claim it's about lost revenue for the government. CNBC estimates that the IRS is missing out on $50 billion a year. But let's call it what it is, a money grab. Warren and her cohort are citing the Infrastructure Investment and Jobs Act, which already has crypto broker reporting requirements set for 2024. They argue that the delay is in direct conflict with this act. But let's be real. This is about control and exacting more money from an industry that's built on the principles of decentralization and financial freedom. Warren has even gone so far as to send a letter to Janet Yellen, the U.S. Treasury Secretary, and Daniel Werfer, the IRS Commissioner. She's sounding the alarm that the U.S. government is missing out on billions. And these proposed rules have some eyebrow-raising definitions. They want to label anyone facilitating crypto sales as brokers. They're also defining a digital asset in a way that could encompass a wide range of crypto activities. The senators are worried that this delay will give the crypto industry more time to push back against these overreaching regulations. Maybe that's exactly what needs to happen. Maybe it's time for the crypto community to stand up and say enough is enough. Because senators like Warren are pushing for a quick implementation of crypto tax rules, not for the benefit of the people, but to fill the government's coffers. This is a blatant cash grab, and it's one that could have far-reaching implications for the crypto industry. Frankly, the recent push to expedite crypto tax rules is a glaring example of government overreach. While they frame it as the loss of billions in potential revenue, it's really an attempt to tighten the noose around the neck of the crypto industry. This isn't about compliance or fairness. It's about control. Warren's claim that the IRS is losing $50 billion a year in unpaid crypto taxes is not just an exaggeration, it's a scare tactic. It's a number thrown out there to justify an evasive policy. The idea that taxation is the path to prosperity is a fallacy that disregards the innovative spirit of the crypto industry. Taxation in this context is not just a financial burden, it's a philosophical one. It's the government saying, we don't trust you to handle your own finances. The proposed rules are a straitjacket on an industry that thrives on freedom and decentralization. Requiring crypto brokers to start reporting user data to the IRS is a slippery slope that could lead to more invasive measures. It's a step towards turning crypto brokers into government agents. And for what? To fill the government's coffers at the expense of financial freedom. The senators might be patting themselves on the back for their efforts, but let's not forget that these are the same people who often lack a basic understanding of how crypto works. Their push for expedited tax rules is not a solution. It's a problem masquerading as a solution. As we wait for the October 24th update, it's clear that the real issue here is not about lost revenue or compliance. It's about a government that's out of touch with an industry that it's trying to regulate but does not fully understand. That is a recipe for disaster. From Capitol Hill's urge for quick tax rules, we journey to the UK's real estate backing a stablecoin. Except, it's not so stable anymore. A real estate-backed coin that's lost its peg? Let's dive in. USDR lost its peg to the US dollar, plummeting to a mere 53 cents apiece. Tangible DAO, the entity behind USDR, cited a liquidity issue as the root cause. Within 3 hours of this depegging, both the USDR and its associated balance token, TNGBL, saw a 50% drop in market cap. Now let's talk about the assets backing this stablecoin. USDR had a portfolio of over 250 real estate properties in the UK. But here's the problem. All DAI collateral was withdrawn, leaving houses to make up 60% of USDR's collateral. This led to a swift and massive sell-off, driving the price even further down. Tangible DAO's treasury now holds 0 DAI, and they only have a roughly $6.2 million insurance fund to cover a circulating supply of 45 million USDR. Some traders are even offloading USDR for a fraction of its value. Despite this, USDR's website still offers a 16% yield, mostly paid in TNGBL tokens. The situation raised questions about whether this was a pre-planned rug pull. A rug pull occurs when the developers disappear with the liquidity provided, leaving holders with little to nothing. Is that the case here? Tangible DAO says no, attributing the Depeg to redemptions, liquidations on its real estate assets, and panic selling. So what's next for Tangible DAO and USDR? The team is working on solutions, including liquidating its protocol-owned liquidity and insurance fund assets. They're also planning to launch a pool of tokenized real estate called baskets, which they claim will be a vital component of USDR's redemption. But let's be real. The path to liquidity for these guys seems to be a long one. Now that we've explored how a lack of liquidity can cause a stablecoin to crumble, let's switch gears. Coinbase's dwindling trade volume has everyone puzzled. Why should you care? Let's find out. Coinbase is one of the largest crypto exchanges in the US. Even so, it's seen a sharp decline in its spot trading volume. According to reports, the exchange recorded around $76 billion in spot trading volume for the third quarter of 2023. That is a staggering 52% drop compared to the same quarter in 2022. The numbers are the lowest they've been since before Coinbase got listed on the Nasdaq in 2021. So why does anyone care? Coinbase's transaction revenue accounts for more than half of its total income. So when trading volumes decline, the platform's profits also take a hit. The exchange had record volumes in May 2021, with turnover reaching $259 billion. Fast forward to September, that number plummets to $20 billion. Now, despite the decline in trading volume, Coinbase has actually gained market share. How? Well, its competitor Binance has been under increased scrutiny from regulators. Binance's spot market share dropped for the 7th consecutive month, and the lost volume has been grabbed by exchanges like Coinbase. However, this isn't just a Coinbase issue. Other platforms are also feeling the heat. Lower cryptocurrency prices, scandals, and high-profile exchange collapses have led to a general decline in trading volumes across the board. Binance's daily spot trading volume is now around $5 billion, less than half of the $13 billion in volume it had last November. Coinbase is also facing increasing regulatory pressure in the US. This, combined with a drawn-out crypto bear market, impacted its trading volumes. The firm is forecast to post a 7th consecutive quarterly loss when it releases its results next month. Analysts expect Coinbase's revenue to be 10% below forecasts. Coinbase's stock has risen by nearly 120% this year, but has lost over 80% of its value since its debut in 2021. The stock is primarily trading just under $80. The exchange has been expanding globally, securing a major payment institution license from Singapore's Monetary Authority and receiving regulatory approval from Bermuda. However, its European expansion plans are on hold due to regulatory hurdles in the US. The decline in Coinbase's trading volume reflects the growing regulatory pressures and the general skepticism stemming from regulatory uncertainty. Trading volumes are down, but don't think that traditional finance is sitting idle. BlackRock and JP Morgan are making waves in instant settlements. Can crypto keep its edge? Listen up. BlackRock is the world's largest asset manager. It took a monumental step by leveraging JP Morgan's new blockchain tools for instant collateral settlement with Barclays. This could prove to be a seismic shift in how big financial players are embracing blockchain technology. JP Morgan's tokenized collateral network is the star of the show. Built on their Onyx digital assets platform, TCN facilitated its first collateral settlement for a live client OTC derivative transaction. BlackRock tokenized shares in one of its money market funds. It then sent those tokenized interests to Barclays as collateral for its over-the-counter derivatives trade. This is monumental because it's not just about speed, it's about efficiency and stability, especially in times of market stress. The collateral between BlackRock and Barclays took just 1 second to post. Compare that to traditional methods, which could take days. Tyrone Lobban is the head of Onyx Digital Assets. He was not shy about the implications. He said ultra-fast collateral movement could bring enormous value to the $25 trillion collateral industry. But the ambitions don't stop there. JP Morgan plans to expand TCN to include other types of collateral in the future. They're diving headfirst into the deep end of asset tokenization. JP Morgan's head of trading services emphasized that this first transaction demonstrates the power of tokenized assets and unlocks new pools of liquidity for margining. Is there any question about whether blockchain is infiltrating traditional finance? BlackRock CEO Larry Fink last year called the tokenization of securities the next generation for markets, and he's putting his money where his mouth is. So what does this mean for crypto? It's a validation of what we've been saying all along. Blockchain is not just a fad. It's the future of finance. And as these financial giants adopt blockchain, they're giving it the legitimacy it deserves. But let's not forget, they're playing catch up in a game that we started. This isn't just about faster trades or more efficient systems. It's about a fundamental shift in the financial landscape. It's about the decentralization of assets and democratization of finance. And most importantly, it's about the erosion of centralized power structures that have held sway for far too long. From BlackRock's big move, we segue to Ethereum, where even the big players aren't safe. Lido's recent slashing events remind us, trust but verify. Don't miss this one. Lido Finance, heavyweight in the Ethereum staking arena, recently disclosed 20 slashing events. These events were triggered by a series of infrastructure and signer configuration issues. The validators responsible were operated by launch nodes and have since been taken offline. The slashing events took place on the Ethereum blockchain on October 11th around 3:30 p.m. UTC. The initial impact? A loss of 20 Ether, valued at $31,000. But that's not all. Additional penalties are piling up as these validators are offline for troubleshooting. Inactivity penalties are also accumulating. Slashing is a serious matter in the crypto world. It's a process where a validator breaches a blockchain's proof-of-stake consensus rules, and the result? The removal of that validator or a portion of the staked Ethereum that they provided as collateral. That gets slashed. Launch nodes admitted that the slashing events were due to infrastructure and Web3 signer configuration issues. They're investigating and taking steps to prevent any further occurrences. Now, what about the stakers on the protocol? They're not directly affected except for a reduction in daily rewards. This will be reflected in the next rebase on October 12th. Lido DAO has an insurance fund of 6,230 staked Ether, worth around $9.5 million. This fund will be used to mitigate the slashing impact, but won't trigger automatically. Staked Ethereum holders will be compensated once the cover method has been decided. Launch Nodes has pledged to reimburse all losses incurred by Lido. Lido itself is no small player. It's the largest liquid staking protocol with $13.8 billion in total value locked. The next largest is Rocket Pool at $1.7 billion. Since the launch of the Ethereum Beacon Chain on December 1st, 2020, only 226 validators have been slashed, roughly 0.04%, so it's not a common occurrence. So, what happened? BarnBridge is the latest DAO in the SEC's crosshairs, facing an investigation that's causing its token price to plummet. The community has voted to comply with the SEC's demands, but it's a move that questions the future of DAOs in a heavy regulated environment. Senator Elizabeth Warren and her colleagues are pushing the U.S. Treasury and the IRS to speed up its crypto tax regulations. Their urgency sheds light on a massive potential revenue source for the government and questions the federal agency's lack of agility in adapting to crypto. USDR, backed by real estate assets, lost its dollar pegged and tanked to 53 cents. This raises serious questions about the stability and trustworthiness of assets in the crypto space, especially when backed by relatively illiquid collateral like real estate. Coinbase is experiencing a significant decline in spot trading volume, a trend that threatens not just the exchange, but the crypto market as a whole. It's a wake-up call reflecting growing regulatory pressures and skepticism surrounding centralized exchanges. BlackRock leveraged JP Morgan's blockchain tools for near-instantaneous collateral settlement with Barclays. This is a monumental move, signaling the increasing entanglement of traditional finance with blockchain technology. Lastly, Lido Finance disclosed 20 slashing events due to configuration issues, exposing vulnerabilities in even well-established protocols. Yet another reminder that decentralization is not synonymous with risk elimination. As I mentioned in the intro, tonight's episode centers around the question of trust, be it in regulatory compliance, taxation, asset backing, or even the technological integrity of protocols. We're at a critical juncture where trust is both earned and tested. As the lines between traditional finance and crypto continue to blur, the stakes are getting higher. Trust, it seems, is the real currency, and it's one that's becoming increasingly volatile. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.